Good evening, everyone. We have a full house today. Welcome, everyone, to our exclusive webinar on ultimate tax reduction strategies for real estate investors. Thank you for taking time out of your busy day to join us. I'm Anchal Dwivedi, Managing Partner at Goldstone Capital Ventures, and I'm joined by my fellow managing partners, Shruti Dwivedi and Dinesh Nair, as well as our guest speaker, Brent Beament. At Goldstone Capital Ventures, we are specialized in identifying, underwriting, acquiring, and managing commercial assets with tremendous potential for value-add opportunities. We have successfully transformed these acquired properties into thriving communities that are both financially rewarding for our investors and highly sought after by the residents as well. We are also specialized in building brand new apartments and other commercial assets as well. We have proudly acquired over 15 real estate assets with more than 1,600 units across prime locations in Carolina, Texas, Tennessee, Wisconsin, Florida, and other major part of the country. We are also expanding our focus in Virginia. We have exciting upcoming projects on horizon spanning various sectors such as assisted living, retail strip centers, new construction, and industrial buildings. This diversification allows us to continuously explore new avenues for growth and deliver exceptional results for our investors. So without further delay, I pass on to Dinesh, who will take you through our current portfolio and latest acquisitions. Thank you.
Hey everyone, good evening. I know it is sweet time, like 7 to 8 p.m. here in the East Coast, and a beautiful day, spring season. It's hard to stay inside, but thanks for joining us at this time. So we have about 15 projects. Most of the acquisitions are value add. This is a recent acquisition in Wisconsin, Serenity Villa Assisted Living, 125 beds. Yeah, this is a student housing, 252 bed in Nashville, MSA, also acquired in the last year. The other few complexes that we acquired in 2022, this one is Ivywood Apartments in South Carolina. This is a new development that we have just started in Winston-Salem, North Carolina, 184 units. Sweet Redemption, it's a beautiful property just outside Cowboy Stadium. We have converted that that building into short-term rentals, so it's we have increased the revenue on these. Just Place, this is another property in South Carolina, 98 townhomes newly built in 2022. And another one, Class B, Shaftwoods, 40 townhomes in the center of Charleston, South Carolina, beautiful Class B asset. So with that, I also would like you to know that we are not advisors in finance or accounting or investment. So just wanted to put it out there, just our normal disclaimer. With that, I will pass it on to Shruti to introduce our guest speaker.
Thank you, Dinesh. Good evening, everyone. I hope you all are having a great day so far. And we are so excited to see you all. And big thanks for joining us tonight. Whether you are a current investor or just starting out the investment journey, we are here to help you to make informed decisions and achieve your financial goals. I would now like to welcome Mr. Brent Beament, who is a successful entrepreneur, investor, and certified public accountant, who currently serves as the president of Beament and Company CPS, a reputable tax advisory firm with headquarters in Utah. He and his wife commenced investing in real estate in 2008. That's right, before the 2008 market crash, and have since been persistent in their investment pursuits. Beament and Company offers tax planning and preparation services to clients across all 50 states of the U.S. Outside of his professional life, Brent is a devoted family man with 5 children. He takes pleasure in exploring new places, camping, archery, hunting, and indulging in any outdoor activity. But before I pass it on to Brent, if anyone has come across any questions throughout the presentation, then please put your questions in the Q&A section, and we will review it at the end of the presentation. Welcome, Brent. Stage is yours.
Thank you. Thank you. Yeah, great to be here. And I'm excited to talk about one of my favorite topics, which is real estate. And yes, we did start investing in 2008. And it was a personal home that my wife and I bought. And within 3 months, we lost about 40% of value, and we were upside down like a lot of people. And thankfully, we held on. It didn't scare us away, and we just continued investing from that point. But I do love real estate investing. And I am a CPA by trade. And yeah, at night and weekends, we're doing some sort of real estate investing. And whether it's our own deals, or we have raised some funds for mobile home parks in the past, or investing in other people's deals as an LP. Like I love all of it. I love seeing all the different aspects of it. So I've taken that, like my personal experience with the investing, and I've been applying it with what I know about the tax law and the CPA and investing world, like how to legally or how to document it correctly for taxes. And that's where I am today. And I've combined that. And I've also done here. Would you mind if I shared my screen? I'll get the screen shared, and we will. I do have some slides.
Yeah, I think you should be able to share it. Okay, perfect.
Okay, awesome. Okay, that looks good. And I've got a whiteboard as well. I'll kind of go back and forth between the slides and the whiteboard, but we've got some really good topics. So one of my favorite things about real estate is like the tax law. Like the tax law can get very complex, but when it comes to real estate, in most cases, it doesn't matter what type of real estate you're investing in. The same tax law applies to all different types of real estate. So say if you were investing in storage units or multifamily home, looks like a lot of the projects that you all are working on are multifamily, like the larger complex or the larger multifamily homes or in apartment buildings. And I saw the short-term rental investment as well. But it could be office space. It could be single family homes. The tax law is going to be very similar, if not identical, in about every aspect across all those different investment types. So that's great. I love that part of it. So I'll kind of give you an overview of the topics that we'll cover. And it's the topics that were sent out in the invite, but we will go over the different benefits of real estate. And I'm sure if some of you have been investing in real estate, you could probably write your own list of things, and it might be similar to mine, or it might be a little different. We'll cover cost segregation, the 1031 exchanges. We will go over the short-term rental loophole. If you've probably heard of that before, or if you have heard of that, I'll kind of give you the ins and outs of it and how it applies to the tax law, and then real estate professional status. Okay, so the first one is the benefits of real estate, and I actually have a podcast episode on this, and I talk about the 4 benefits of real estate. But right here, I've listed 5. But there's one that I've thought was so important that I just didn't bring it up in that first podcast, that one podcast episode. But I keep bringing it up, and it's an additional one. It's actually number 4 that I've added here. The ability to use leverage is an additional one. But as you all know, like cash flow, if we can get especially in today's market, maybe where cash flow might be a little less with the high interest rates, if we can get a property with cash flow, it can be great. And with most, when you're raising funds and when you guys can leverage each other's money and your resources together, you can usually get bigger projects that a lot of times cash flow better than like a single family home. So that's a benefit. The appreciation of the property, as I talk about that, it is the growth of the value of the property while you own it. It could be 6 months, a year, 5 years down the road. As it's going up in value, you're not paying tax on it as it goes up. Remember, it's not a taxable event until you actually sell it. But that is just one of the things as you are considering like your return on your investment. Don't simply look at the cash flow. And if there's like Sometimes there's like the types of dividends or preferred returns you might get from an investment deal. That's just one aspect of it. But sometimes I have like, as if you're listening to this, you are likely interested in real estate investing, and you've thought of like an alternative, or maybe a kind of like the simpler approach of just sticking money into a 401k, or sticking money into like the stock market and waiting for it to grow. And if you go look at the averages of the stock market, say it's an 8% average return over a 10-year period. A lot of times people get stuck on comparing like an average return in the stock market to the cash flow you get off real estate. It's like, well, if I have a property, and I'm sure you on these calls, you guys have covered cap rate. If you go, if this property has a cap rate of 6% and it's kicking off 6% of cash, I could go put my money in the stock market and earn an 8% return. But it's not quite comparing apples to apples. So you've got to add some of the additional benefits that you get. You're not just getting the cash flow, because when that goes up, you're also going to get the appreciation of that. And the amortization, when you hear that word, amortization, that's really just the loan getting bought down. It's not cash you're getting immediately. It's your equity that's building up over time. And that's like the silent wealth builder, where just over years, even if you had a property that was breaking even, over the years, as your loan gets paid down, who's getting the equity? It's you as the owner, or you as the investors are getting that equity. And it's not going to the bank. The bank is only getting paid back a fixed amount. And this number 4, so I've got a real estate analyzer. It's a spreadsheet that I like to share with people. Let me see. Actually, I'm going to pull this up. Like, this is important enough. I'm going to share it on the screen here. So when I go look at, I've got a spreadsheet shared here. And if you want to copy the spreadsheet, I've got the link at the end of the presentation, but it is through the wealthgame.io website. It's in the free basics course that I've got. But something quick to show is on leverage. I want you to see what leverage can do to a rate of return on an investment. So I'm going to highlight a couple things. I'll make this a little bigger. Let's see if I can zoom in on that. I think it'll be a little easier if it's a little bigger.
Yeah.
So look at this. So this is, I'll kind of highlight a couple of the key things here. So this is net operating income, and these are just made up numbers for now. This isn't analyzing a deal that you guys have been looking at. We haven't discussed this before, but just a hypothetical property. The NOI, net operating income, hypothetically is $495,000. And the asking price on this property is $8.5 million. And so a cap rate, which is you divide the net operating income, divide it by $8.5 million, cap rate's $5.83 or 5.83%. And if we just assumed a 25% down to buy that property, you're going to need $2 million to buy the property on an $8.5 million property. On this worksheet that I've got, I've prepared a return on your investment, which is a return on your cash that you're putting in, like a return on your equity, a return on your investment. We are estimating it based on the cash that you have in the deal, not on the total purchase price, because the bank is putting up the other 6.3 million. You're putting the 2. This return is on how much cash you're putting in. So in this, I'll skip over some of this, but it's about a 20% return. And I've got some cash flow estimates as well. And I don't know the end result here, but if we change this to say a 10% down instead of 25% down. So now instead of using 2 million of cash, you're using 850,000. The cap rate stays the same, no matter what the debt is. Your cash flow will change and your overall return on the investment will change. So look at this. So what was the last? Look at this highlighted green one at 45%. With the 25% down, it was a 20% return after considering these aspects of it. If you change it to 10%, it's a 45% return after considering these aspects. So this is the power of leverage, and it's hard. It'd be hard to cover like all the details of it, but I get really excited about this. Like when a client asks, like, okay, I've got, as a simple example, say I've got $1 million and I want to do I want to buy a property or real estate with $1 million, or even with 100, whatever the dollar amount is, their options would be, say with that $1 million, they could go buy a $1 million property with cash, or they could go, say, do a down payment, a 25% down payment on 4 different properties. So now they've got $4 million of assets, and they've taken on some debt to buy the rest of it. But the same applies to if you're an LP on an investment deal. If you're combining money with other people and you all together are using leverage, you're multiplying like you're multiplying the amount of assets that you're acquiring with the same amount of cash. And then the returns are all multiplied on that. So I'm sure you guys have covered that, or in your analyses, you're doing something similar to that to like find the right amount of debt and make sure you've got cash flow with it. But it's pretty amazing to see the returns there. Okay, then the tax benefits right here, and this is why I get most excited about this, but you do have the opportunity to have tax-free cash flow. And that is the reason it's tax-free. So you can get returns on your investment, or you can get cash out of an investment property. And the reason it's tax-free is because of the depreciation, which is the B item right here. Like even the standard depreciation, if we're not accelerating it or doing the bonus depreciation, which you've probably heard is kind of expiring over the next couple of years, even if they don't renew that, you can still get this tax-free cash flow with the basic, like the regular depreciation. And then being able to do 1031 exchanges is definitely a tax benefit. We're going to talk about that on one of these next slides. And offsetting your other passive income with passive losses from real estate. This will be a topic of today, is passive losses from real estate, when they can be used, when they can't be used, some potential ways around it, like ways to actually be able to use your passive losses. And this last one, it's cut off a little here at the bottom. And there we go. But in some circumstances, you can offset any of your other income with real estate losses, with the accelerated depreciation. And these are some of just really briefly, just talked about some of those circumstances where you could potentially offset any of your other income. In reps, which we're going to talk about, short-term rentals, we're going to talk about. There's a low income exemption where if your income, and the income's really not that low, but when you have less than $150,000 of income on your tax return, some of your passive losses can be used, like from a K1. It's maxed out at 25,000 and it phases out when you're above 100,000 of income. But some of your passive losses can offset any of your other income. So sometimes it's like you've just got to do other types of planning if you've got a K1 with a loss coming in, like say as an LP, if you've got a loss coming in, you're like, I want to use this loss. You might need to do some planning with the other parts of your tax filings and your other income that's taxable to get that down so you can unlock that. But then whenever you sell a property, it's so important for this. So any of you that if you have invested in real estate, and if you've ever heard from your accountant or CPA or tax preparer, or if you've been doing your own tax return, if you've ever had a loss that is limited and you've not been able to use that loss in a year, make sure to track it. Like our system, we have a system that tracks it and it carries it over to the next year for us. But we see all the time where people forget. They either forget or they just don't carry these losses forward. And if you never add them, they can be lost forever. So just make sure these losses, if you ever have a limited loss or a passive loss carryover, I think of that for the keywords. Just think like, I want to make sure that this goes to my next year's tax return. An important time to do it would be if you're switching tax return preparers, or if you're looking at your past years, just make sure that carryover of those unused losses goes forward. Okay. And I'm open to, if you guys wanted to do questions at the end of each one, kind of like each section, or if you want to do questions all the way at the end. Do any of you have a preference of how we do it?
Yeah, either way is fine. If you can put your questions in the Q&A box, that will be great. and we can probably address them after each section.
Okay. I think that would be easier just so because we're kind of on the topic of it. And
Right.
I do see that we have a question in the Q&A, so I'll get that one there. Let's see. So the question is, are passive losses applicable to federal, or is it applicable to states as well? It's most of the states. There might be a state or two, and I don't think so actually, but most or all the states will follow the IRS allowance of passive losses. So if the IRS allows the losses to be released, the states will usually allow them to be released as well. There are some states that don't allow like some parts of the accelerated depreciation. I think all will allow regular depreciation, but some will limit accelerated depreciation. But those passive losses, they're usually linked. If you're using them on the federal side, the state will allow it as well. But yeah, that's a great question. Okay. Well, if there's no other questions, let's jump into the next one. Oh, we do have one more question.
Yeah.
So is it better to compare cap rate or cash on cash with the S&P 8% return? I would think cash on cash would be better metric to compare. Wouldn't just look at the cap rate. I wouldn't just look at the cash on cash return or the internal rate of return or return on equity. I would get comfortable with as many metrics as you can and compare all of them. But I think the cash on cash return is a very good one to look at. Yeah, the next question is, what is a passive loss? And I could have had like a slide about like the downside to a passive loss, but that's a good question because I mentioned it quite a few times in talking just a minute ago, but I didn't really define what it was. So a passive loss is when you are, say, an LP, you're a limited partner in an investment, you've put money into the deal or into the investment, and you're normally a small part of the investment, or more like small in the amount of money or in the amount of time that you spend in it. And when you don't spend a lot of time in a deal, you're typically going to be passive. And there are some very specific, I don't want to start throwing out too many numbers with the IRS, but there's specific hour requirements where if you get over certain hour requirements, you could be considered non-passive and some of these losses could be allowed. But if you're an LP in a deal, that specific investment is more than likely a passive investment for you. It's like, it's kind of a two-edged sword in a way. Like we want cash flow. We want investments that are coming back to us with very little time involvement, right? Like we want those very passive investments for just the sake of them being passive and us getting paid for them without us needing to do a lot of work or spend a lot of time. But we're almost penalized in a way when we don't spend a lot of time under the IRS rules where they say, well, you can't use this loss to offset your income. So as an example, let's say you are a doctor and let's say you earn a W-2 wage of $300,000. If you take that $300,000 and if you didn't want to pay any tax on it, and you take $300,000 and you go put it into an investment deal, like into real estate, and if that, maybe rough numbers, it might create a $100,000 deduction just after cost segregations and everything. But if you had $100,000 loss on your investment in real estate and all you did, you wired the money, you signed the paperwork and you wired the money, that is going to be a passive investment for you. If you didn't put together the deal, you didn't raise the funds, you didn't acquire the property, you're not part of the day-to-day. It's just money sent and you get a check every month, maybe as a dividend. That's a passive investment. We can't use that loss to offset your W-2 wages. But we're not going to stop there because that's kind of the downside of passive investments. There's some of these at the bottom of the screen. I mentioned some of the ways that you can use those passive losses in passive investments to offset your other income. And that's one of my favorite things to brainstorm, but there are several different ways. There's quite a few different ways that you can do it. But that's, if I could give people like one word of warning, it's like, don't wait until you're getting the K-1 and doing your tax return next year to find out that you can't use a loss. I would do some planning ahead of time and figure out what you can and can't use, what your income is, what the other income is. But that's kind of the rough down low of the passive investments or the passive losses.
Oh, we have another question.
Okay, and we'll get into that question. We do have the rep status, and I think we'll jump into those questions with the rep status a little later, and we'll go into more details. I'll actually cover some of these other circumstances when we get to the rep status of how to use your passive losses. So let's go into, we'll go into cost segregations. And this is, I touched on it just a second ago as well, which as an investor, or even like as the person being the GP in a property, or if you were buying a property on your own, in my opinion, as long as you understand like these three like main components of what a cost segregation would be, I think that is a great understanding of it, and it'll help you make decisions and potentially like, or at least roughly estimate what the deductions could be. But as long as you get these concepts, I think you'll be pretty far ahead from what a lot of people understand of cost segregations. So I want to kind of demystify what it means, but I don't want to like go down into too many details to make it too confusing. But if you think of like when you buy a building, or just think of a piece of real estate. So it's got land, right? And it's got land on it. It's got a building, and the building has a structure and a roof. And then the building has things inside of it that make it usable, like the electricity and the carpet and the flooring and the shades over the windows and certain types of light fixtures. But what a cost segregation does is it's a formal process where you go down and you itemize and you list out the different types of these categories within that building. So if it was a $1 million building, I didn't give my rough estimates here, but I do have I've got a sheet that I can send over to you all after, but it's a rough estimate of different types of real estate and the different percentages roughly of how they end up. And this is from cost segregations that we have seen and cost segregations that we've done like through the firm. We've come up with these percentages. But the building portion, which right there I've listed as foundation, roof, and structure, like I call it the bones of the building. This is the regular or the slow, just like that regular and the default depreciation that you get on a building. And to calculate that, you take however much we're applying to the building, like whatever percentage, and divide it by 30. So if it's a $1 million property, and we said, well, take $500,000. If about 50% of it was allocated to the building portion, divide it by 30 years, it's about $16,000 a year. And that's the regular default depreciation. And I've rounded to 30. It's really 27 and a half years, but we don't need to get into all the details of it now. So then you might be wondering like, okay, well, what about the land portion? So when we're doing cost segregations, like we're looking at the raw, the unimproved parts of the land. So if you think of when a building is developed, like you might be grading the property, laying gravel and laying concrete and roads and building out grass and landscaping. None of that is included in this. This is the unimproved part of it. And sometimes like the county will give us an amount for it. Sometimes we've got to go look for like comparable land that's unimproved and find a value for it. But this, as a rough estimate, it might be about 20% of the total would be land. So of the $1 million example I'm giving, maybe $200,000 goes to land. But the depreciation, there's no deduction on that. In the ongoing years, we don't get any tax benefit from it. It just kind of just sits there year after year until it's sold. But then this bottom one, number 3, this is the stuff that people get excited about. Like when it comes to bonus depreciation, the keywords you probably heard, accelerated depreciation or bonus depreciation, or like, oh, the first year, like a big deduction in the first year, it all comes from this, or most of it comes from these items. And these are things, if you could go into that building and remove it, like remove it without destroying it, like carpet can be removed. Certain types, I've got like tile ceilings in my office, they can be removed. Others, like the furniture and appliances, all that stuff can be removed. That's all this other property. And you can actually include this one's a little harder to, like, it's a little harder to maybe make sense of it, like with how I explain how it's something you can pick up and move. But the land improvements, like the landscaping, if you've planted flowers and trees and grass, fencing, pools, all this stuff could also be included in that. So in this rough example, about 30% of the building, of this hypothetical $1 million building, about 30% of that, so 300,000 would be 300,000 would be the amount of assets that are eligible for accelerated depreciation. And then you all have probably heard there's a new bonus depreciation rate for 2024. 2023, it was 80%. 2024, the bonus depreciation amount is 60%. So we take 300,000, multiply it by 60%, we get $180,000 first year deduction from depreciation, from this bonus depreciation, this accelerated depreciation. So you might wonder, like, well, where does the other 120,000 go, part of that 300,000? Well, the other 120,000 can be written off over 5, 7, or 15 years. And it gets added to a regular schedule and a depreciation schedule, and we write it off over the next 5, 7, or 15 years, depending on the type of asset. So cost segregations, like they got really popular in 2018. Like the tax law changed and it started to allow bonus depreciation for real estate. And that's 2018 through the 2022 tax returns. It was a 100% bonus depreciation rate. And now that's tearing down. 24, it's 60%, 2025, it's 40%. My opinion of it, and you might have heard about this, but in January, the House passed a law. Like the House was ready to sign on this law and send it to the Senate to be signed and turned into law, where they were going to bring back the 100% bonus depreciation rate. And they were going to retroactively do it for 23. It was going to apply to 24 and 25. They did not pass that. And I think the Senate just got distracted. But in my opinion, I would expect they're going to do something in the next year to bring it back to 100%. And so I think 24 and 25 is going to be really good, like even better than it is already for real estate investments and mostly the tax benefits of it. Okay, so that's cost segregations. It can be a complex thing, but we've broken it down just in a few minutes there. Are there any questions so far with cost segregations? And I'm going to pull up a whiteboard here in a minute too, if we're going to run any specific examples with any of the questions or anything. I'm usually a whiteboard type of person, usually not the presentation type of person, but that's a great question. So we're going to go back to the question that just popped up on the cost segregations. So is the cost segregation offset when the property is sold? And I'm going to pull out the whiteboard, because I think this is such an important topic. It's a common question, a question about the recapture. It will, like the recapture of, we got the whiteboard here. So to give you a little like visual representation of like what I just explained on how we're splitting up the property into 3 different categories. Remember, we've got the building, we've got land, and we'll just call this other. And then the percentages, and we'll just say this is a $1 million property. Building, 500K, land, 200K, other 300K. So here's what happens when you sell the property. And let's say year 1, we're going to draw this little diagram. So year 1 is the acquisition. And then we'll do a year 2. We'll just call it the sale. a sale in year 2. And this is the depreciation. So year 1, you get a deduction. Well, I think it was roughly like a $16,000 deduction. And year 1 depreciation on the land is 0, right? And then with the other, we're accelerating. I'll just keep it simple. We'll just say it's 60% of that. And what did I say that was? It was 180,000. So $180,000 deduction. So total depreciation on that is $196,000. So let's run another hypothetical scenario. Let's say in year 2, like the real estate market is, let's say it's pretty stagnant. You were not able to do the value adds that you wanted to do. In year 2, let's say that you sell it for $1 million. So a sale for 1 million. So you might think it's like, well, I bought it for $1 million. I sold it for $1 million. What's the capital gain? You would think it'd be 0. Like it just kind of feels like that would be the right number because you bought it or you sold it for the same price that you bought it for. But that question, where is this the cost segregation offset when you sell it, or is it recaptured, which is what it's actually called? It is. And this $196,000 in the year that it sold would become a recapture. I'll say recapture of prior depreciation. That would actually, I'll just write it here. I'll just say increases capital gain. And in this case, there was 0 capital gain before, but when you sell it, it would increase the capital gain from 0 to $196,000. So there would be a gain when this property is sold. And that gain, if you don't do a 1031 exchange, which we're going to talk about next, if you don't do a 1031 exchange, or if you don't roll it into another property that can offset that, or another type of investment that can offset it, or some sort of loss, and being able to, if you don't create a situation where you can use some of your passive losses to create income, or to create passive losses and be able to use them in the year, then you would have to pay tax on the $196,000. So you wouldn't be worse off. So one of the questions is like, well, I'll be worse off because I'll have to pay tax on that. Well, in that first year, remember how much money that $196,000 saved you. So if you were, let's say you had $500,000 of income, and if you could use this full loss, and remember it's got to be either passive income or have one of these other loopholes. But if you use that in the year that the loss was given to you, your taxable income, it's about $300,000 instead of $500,000. So you're saving tax, whatever your tax rate is, you multiply that loss by your tax rate. And roughly with that amount of income, it'd be about 1/3. So you take $196,000, multiply it by 33%. It's a $64,000 of tax savings. That's money back in your pocket from that $196,000 loss. So there is, I don't want to get too much into the details to throw people off, but this recapture, like right here. So if you sell the property in year 2 and you have to recapture $196,000 of income, that recapture is capped at a 25% rate, which is pretty amazing. If you're over here in the $500,000 income range, like if you're single, you're paying a 32% tax rate. And the recapture the next year, if it's capped at 25%, you are better off, even though you recaptured it in the next year. If you can use that loss this year, even with the recapture, you're still going to be better off because the recapture is capped at a 25% rate. And that's definitely, if you're looking at recapture and you want to know exactly how much tax savings you've got, I'd make sure you're running the numbers on it. And like at a minimum, you're not going to be worse off. It's like what I like to tell people, like, you're not going to be worse off with the recapture. And especially in investment deals, when there's money getting raised and there's multiple owners, just like every time we've ever looked at it with people, it makes sense to just accelerate the depreciation, do the cost segregation, because one of the owners will normally, or some of the investors will normally be able to use it. And what it does for you is it creates, like, it'll give you a deduction, like say a passive loss, and it'll give you more opportunity down the road to invest. Like it just, like, I like real estate because it just keeps the door open. Like, because as soon as you pay taxes, as soon as you file a tax return and you owe those taxes and you pay them, like, that is closed. Like you're not going back. You can do amended tax returns, but if you're not doing that, like it's a done deal. Like you're never getting that tax money back. But what real estate does in accelerating the depreciation and the 1031 exchanges, I have seen some people, they get worried. They're like, I'm just going to have to pay this at some point, but it buys you time. And that's one of the the most limited resource is time, right? Like we all run out of it. We only have a limited amount of time. It buys you time to get into other investments, to do 1031 exchanges, to set yourself up for success and saving on the tax and growing your wealth. So that's why I like real estate and accelerating depreciation. But yeah, great question. Okay, so yeah, good. We've got, so extending this example, says in the same example, in year one, if your passive income is 0 and you claimed bonus depreciation for 196,000 and you sold in year 2 for $1 million, what are your tax implications? Yeah, and great question. I right at the bottom of this one, well, I think I barely mentioned it. Yeah, right at the bottom of this, and one of the benefits of real estate investing, I said released when selling your property. And so what I mean by that is the loss. So in year one, in this same example, let's go and delete this. And we're going to say, nope, you can't write this one off. We'll say that's a passive loss. So passive loss. And we'll say that was in 2023. We'll just say carry over to 2024. There's no tax benefit to you in that year. In 2023, when that passive loss was created, you got the K1. But then in 2024, the property sold, and there would be a gain, like on the K1. You're going to be sent to K1 that shows a gain. But on your personal tax return, you're going to have this passive loss carryover that when it's sold, and it's like on our side, like if I'm filing someone's tax return or whoever is doing it, there's a box you have to check. And you have to say, this is the final year. Like this is the last K1 I'll ever get from this activity. And in the small print somewhere, it'll say, and release all the prior losses, all the prior passive losses in this activity. At least that's what happens when you check that final year box. So it's going to be offset. So my long way of saying it'll be offset, and it would end up being a net 0. Like if it sold for $1 million, your loss is going to be released in the year that you sell it. You'll be able to use that loss and it'll offset your capital gain. And like the recapture rate, like it'll completely offset that. So you wouldn't have to worry about that as long as you've got that carryover. And it's like, this is the part that scares me a little with some of the tax returns, because some of the investment deals, like they might go on and on for 5, 10, 15 years in extreme cases. They might go on for a long time. That whole time, every single year, that passive loss carryover is linked to that property or linked to that K1 that you're receiving. So you need to make sure that that is tracked and carried over each year. So let's hop into 1031 exchanges. I think we'll cover it briefly. I don't think we'll need to spend a lot of time on it. But as you've all heard, 1031 exchanges, it's a way for you to sell the property. And instead of paying tax on the gain in that year, you roll the funds over into a new property, and you got to identify within 45 days and close on the new property within 180 days. You can't touch the cash. It's got to be held by an intermediary. But as long as you do that, the funds can go into the new property. And instead of paying tax on the gain, this new property, you just reduce the basis. And I say just reduce the basis. It's a form, it's like a process that you adjust the depreciation schedules and report it correctly. But the impact of it is that the basis of this new property is reduced. So it does impact the depreciation on the new property, but the benefit is you're not paying tax on it when it's sold. And it does, and we just talked about recapture. It does help you, and you can avoid some of the recapture. It gets a little complex in that specific calculation. There could be, if you're rolling over all the proceeds, you won't have any of the gain, and you won't have any of the recapture. Something to watch out for with this though is when you have an investment in, or if you own a property with other people in like say one LLC or one partnership, that LLC or that partnership, that's the person or that's the entity on title. So something to remember with 1031 exchanges, whatever entity holds title, whether it's an LLC, partnership, individual, whatever holds title, needs to hold title when you're buying the new property as well. So it's possible, we won't get into it today. It is possible to own a property with other people and have each of you go and do your own 1031 exchanges. It gets quite a bit more complex, but it's normally you've got to go own the property by yourself to do a 1031 exchange, or get into some of these like alternative structures. Okay, and then there's a question on the 1031 exchanges. The question is it better to offset the gain against passive losses or do a 1031 exchanges? How do you evaluate the benefits? So if you have, like with this, so with this one, if we have two options of offsetting the gain with the 1031 exchange with this passive loss, or doing a 1031 exchange, really it's going to be the same in the end either way. Because if you sell a property and you have a gain, if you sell a property and you do a 1031 exchange, your gain will be 0. And if you release the passive losses and you have the gain, the net impact is going to be 0. So I would say either way works. I think it would probably just come down to if you can do a 1031 exchange. Remember, if it's you, like you've got to be the one holding title to it, or the whole partnership, all the investors of that partnership, they would all need to do the 1031 exchange. So that would get a little more complex. But you're thinking about it the right way though, because I would do whatever's most tax advantageous. And something to think of, sometimes people, like they might have a gain that's like I'd make sure to think of the big picture when you're trying to decide if a 1031 exchange makes sense. Sometimes I've seen people have very small gains and they want to do a 1031 exchange. I'm like, it doesn't make sense. You don't need to have the cost of the 1031 exchange. You might as well release that loss. Some other times where it makes sense to not do a 1031 exchange could be if say you have a really low income year. If your income's really low, some of the capital gain could be tax-free completely to the IRS. Like if your income is less than, it's about $100,000 if you file a joint tax return, the capital gain up to $100,000 could be tax-free. So I'd be looking at those pros and cons. Like before you decide to do the 1031 exchange, I would do an estimate and a tax projection of how much tax you might have from the sale, and then decide from there. Yeah, great questions. Jumping into the short-term rental loophole, and it's a loophole. You'll see down here, I wrote that we're talking about passive losses. So what this is a loophole to, it's a loophole to the passive loss limitation. And remember, the problem with that is that we can't use passive losses to offset ordinary income. Like passive losses can't offset your W-2 wages unless, and this is one of those loopholes, unless it's a short-term rental. There's others which we'll talk about later, and we've talked about some. But if it's a short-term rental property, it needs to be, or actually the reason for this, the reason it works, because rental properties, like rental income by default in the IRS tax code is passive. Like it's just labeled as passive by the IRS. But if it's a short-term rental, and if you're managing it, like you're involved with short-term rental, you're talking to the tenants, or you're very involved in it, then it can be classified in a lot of cases as a trade or business instead of rental real estate. Think of it kind of like a hotel business, like a hotel or a motel, like that's there. You're renting rooms for a night, but think of all the other things that are included with it. Like you're offering breakfast, and you're dealing with people every day. It's more of a business and not as much like real estate under the tax law. But to qualify as a short-term rental, your rentals need to be, and this is complete standalone to the IRS. Like a short-term rental is different under all sorts of cities and zones and counties. Like in Hawaii, most of the short-term rentals, they've got to be 90 days or less, or in 90 days and less is a short-term rental in Hawaii. 90 days and more is long-term. But under the IRS, it's 7 days. You've got to have 7 days on average stays for your tenants. So if your tenants are all staying there for 30 days each, that wouldn't work. If they're all staying there for 3, 5, 7 days, your average is likely going to be less than 7. But what this does, so I'm just kind of pulling this up. What this does is it creates like that in this same example. Let's say you're a doctor and you're making, we'll kind of delete some of this. You're a doctor, you're making $500,000 a year. You go buy this $1 million property we've been talking about. We'll say this is that's your doctor W-2 income. If you and your spouse are managing this property, that negative $196,000, you can use that as a loss. Just go $196K, and that can offset the $196,000 of your income, and that will save you about $65,000 in taxes. So now it's like as you start analyzing investments, you go, okay, does this make sense? Like if I'm going to get this big amount of tax benefit, does it make sense to use this as a down payment? And yeah, if you had to put $200,000 down, but you're going to get $65,000 back in tax savings, it might be a little easier for you to make that decision. But this would be how it looks for a short-term rental. And this is, if we drew out, let's say this is your taxes for 2024 or 2020, year, 60%, we'll go 2024. Top of it, you're going to have your W-2, 500,000. Down here, you'll have the negative 196. That's we'll say short-term rental loophole. And then you'll have your personal deductions are still going to be there. Let's say you got $50,000 of personal deductions. That's part of the calculations, and we whittle it down until we get to your taxable income. Because your tax is all calculated, like the tax scales and the tax brackets that you've all heard about. It's as long as the numbers can offset each other, it's just going off of this number right here. It's just calculate tax here. You can just kind of skip over all those other steps because you're just calculating the tax at the taxable income level, as long as it can be included. So that's the short-term rental loophole. And then there is a question, do we have to hold the property for 2 years for a 1031 exchange? And that's likely after you buy the property. I think your question is after you sell the old property, buy a new property, and keeping that for 2 years before you sell it. I have heard people say that's a rule of thumb, or it's good to do that just because like the IRS doesn't think you were just trying to kick the tax can down the road more than you can. But if you got an offer on the property after you did a 1031 exchange, you don't have to hold on to it for 2 years. You can sell it at any time after you do the 1031 exchange. And as long as those are adjustments to the basis are done right, like I've talked about here, like it's the calculations are going to be correct, and the IRS is not going to have any issue with you selling a property that you did a 1031 exchange on. Okay, and then the short-term rental loophole, if there's any questions on that. Yeah, we've got the last one here. Let's go there. The real estate professional status. So I love, like, the more if you hear me talk or hear any of the podcasts or videos or anything, I love talking about the opportunities of like ways around things, but doing it legally and finding the loopholes in the tax code and just finding ways that you could qualify for things. But you will notice a lot of these require you to change your facts and your circumstances, like potentially change the way you're doing things, or maybe change the amount of time you're spending on things, or maybe even the types of investments you're getting into. It takes work. Like a lot of times it takes a lot of work on your part as an investor, but this is definitely one of those. So if for a real estate professional status, so remember that with this one, the problem is that we have passive losses from real estate. Remember, the default way that real estate losses come to us is that it's passive. That's the problem. This is one of the solutions, like one of the ways you can get around that. And there's two main tests for it, and you have to pass both of these tests. And I'll just go out and say it right now. You and your wife cannot combine your hours. It's got to be your own hours. But this first one, if you spend 750 hours a year in real estate, and I want you to think of like everything related to real estate, from the land development all the way up through construction and construction and management and brokering, buying and selling properties, repairing it and maintaining it later, all of that, like from start to finish, ground up development, all the way to selling a property, all of those hours can be included. Like we have some clients where like 1 year they'll spend, like they'll be remodeling a property and they'll spend 1,000 hours in 1 year, and they've remodeled it. They did a lot of the work, like very hands-on people. But the next year they spent, say, 50 or 100 hours just managing the property. It's crazy to think, but the tax law can and will treat you differently depending on how many hours you spend on it. And so I would track your hours. Like if you think you're going to get close, or if there's a reason for you to maybe need to use those deductions, or if you can't use them normally, like this might be something that works for you. This second test, so this is kind of a catch, or it's kind of hard because sometimes people have the 750 hours, but they work a full-time job, or they work another job or something, and you'd have to do real estate more than that other job as well. So if you work 2,000 hours a year in a full-time job, say you're an accountant, or say you're a doctor and you work 2,000 hours a year, and you work 750 hours a year in real estate, you would not be able to be a real estate professional. You wouldn't be able to have that status for the IRS because you don't do more work than your other job. We do have some clients that have crossed that threshold. Say someone that works 1,500 hours a year doing their full-time job, or mostly full-time or part-time job, but they went and built something, or they spent a lot of time in real estate and it was more time than their full-time job. Then you'd have to not only get the 750 hours, you'd have to get like 1,500 hours. But this, like the opportunity I love with this, I've done a couple podcast episodes on it. It's when your spouse qualifies as a real estate professional. So as an example, say you're the doctor and your spouse doesn't have a job. Like say your spouse helps with the kids or helps with the house, or it does have a part-time job, but you could have your spouse get involved in the real estate, and your spouse could spend the hours. Your spouse could do a lot of the leasing and calling the tenants or the management of it. If your spouse gets over the 750 hours, when we file your tax return, like this right here in this tax return example, this could be you, that could be your wages, and this could be your spouse's loss, like your spouse's real estate loss. And because you filed on the same tax return, that loss can offset your income as well. It's pretty amazing. Okay, so we've got some questions. That is the last topic. We've got questions. Do you guys want us to go over? Do you want me to go over and keep answering the questions? I'm happy to stay on and keep going through these
Yeah,
questions?
sure. Yeah, let's go ahead. This is pretty interesting. So,
Okay. Okay. Very cool. Yeah, we've got first question is your regular W-2 income. So your regular income is in your resident state, say R, and your real estate investment is in a different state, say NR. So resident, non-resident, where you do not have any income. You don't have any income in the non-resident state. In year one, and yeah, in year one, year two, you have passive losses. In this scenario, do you need to file taxes with the non-resident state in year one and year two, and why? Now you sold the property and booked income from real estate. Do you file tax returns with state Y or only with the resident state X? How does the offset work with prior year losses for state non-resident returns? So if you have, so yeah, as this is a good example. So say you're a resident of Texas. Texas doesn't have a state income tax, right? You don't file a personal tax return for Texas. But let's say you have a rental property in Utah. Say in Park City, Utah, you have a rental property. In year one, let's say you bought it. It's had, let's just say $10,000 of positive income, but you had all sorts of losses. I would, in my opinion, I would file the Utah tax return. You're not going to owe any Utah taxes in that first year, but you had Utah income, even though it's not taxable because it's offset with the expenses. So you should file the Utah tax return. It'll show as 0 in year one. Then year two, when you sell the property, when you have the gain, like say you have a passive loss carrying over, Utah will recognize when you file it, you'll have that Utah carryover of a passive loss. So when the Utah capital gain comes in, that passive loss can offset that. It can offset that capital gain. So you, in that example, you wouldn't owe any tax in Utah if you bought it and sold it for the same amount. But let's say you've had still a Texas resident, say you had the Utah property, and let's say it had a positive capital gain. Let's say you held it for 10 years. Utah, and even though you're a Texas resident with 0 tax, when you sell that and there's a capital gain, wherever the property is, they'll want you to file a tax return in that state for the capital gains. And in many states, most states, as long as they have a state income tax, you'll file and you'll pay capital gains tax in that state. Unless, like in your example, you have a passive loss carrying over to offset it. But if you had a positive taxable gain, you would file in that state and pay tax in that state. And the same counts for if you own the property directly or if you're an investor in a property. A lot of these K1s that will come back to you, the K1 will have, or you'll have a federal K1 and a state K1. And so that'll kind of be an indicator of if you need to file in that state or not. And then, question on, can you please touch on international 1031 exchanges, specifically selling a property in India and buying in the United States? Well, yeah, if you have, so if let's say, if I'm assuming you file a United States tax return. So if you're a resident of the United States or a citizen of the United States wants you to file all of your income, all of your worldwide, all of your global income will also be reported on your United States tax return. If you paid tax on that in India when you sold it, there could be, and I don't know India, if there's a 1031 exchange equivalent of India, but let's say there's not, and you paid tax in India on that, in the United States on that capital gain, or when you're filing the tax return to report that capital gain, there would be a foreign tax credit you would take. We would report that as being paid to India. And so you might not owe any tax after all if you have to pay tax in India. But let's say there is a 1031 exchange equivalent and you want to roll it over in United States property. On the United States side, I am like, if you had to reduce the basis, I am not 100% sure if you'd have to reduce the basis. It seems like it would make sense that you would reduce the basis on the United States purchase in the same way that you do it within the United States. That's probably what I'd recommend without looking at any details. That's what I'd expect you'd need to do. But you just reduce the basis of the United States property. But the 1031 exchange is like, it is important to get it correct on the the acquisition side, that sale in India or the sale of any 1031 exchange, that's the critical component to it. That's the critical part where you don't want to pay tax on that sale. So however that's reported is definitely critical, because the new property in the US, that basis could actually be adjusted years down the road as well. But just as long as you're not paying tax on the sale in India, that would be important. But yeah, I wish I could answer more clearly and thoroughly with related to India, but we will jump into this next question. Let's see. We covered this one, so we can mark this one as answered there. And then I love this question, Molly. Could this hour in other education count towards your real estate professional status? And I wish I could say yes, but there's very clear evidence from the IRS that education would not count. Like reading a book about real estate wouldn't count. Like even going to like real estate classes or training to become a real estate agent, that wouldn't count. But if you say you were joining a call related to a specific investment, and say you and partners were talking about how to acquire the property or how to increase the rent on it or add value after you got it, those would count, in my opinion. Like if it's part of the process of acquiring the property, then I would say yes. Like you don't have to be physically swinging a hammer for it to count, but general education in real estate, I would say no. But if it can be linked to a specific property, then I would lean towards yes. And so my list is not exhaustive. Like it's not a list of everything real estate related, but I would look at this. I can send you guys the slides, the sheets here, if that's helpful. But I would make sure it's linked to a specific property. Yeah. And then the follow-up question was, there's no intermediary in India, so the funds would go straight to the seller. And so don't know how you do a 1031 exchange between two countries. Yeah, that's a good point. I don't think, there wouldn't be like an international wire to the seller or the seller of the new property. So I don't think it would work. But yeah, it's good to think about it and ask if it would. This is a question we've had in the last couple of weeks, actually, with some clients buying some properties out of the country. So say you wanted to accelerate depreciation. If we go back to like a cost segregation on a foreign property, you can do cost segregations on foreign properties. Like that can work. You can accelerate depreciation on foreign properties. You could have a beach house condo in Mexico, and that could qualify for the normal deductions you get through real estate and the accelerated and bonus depreciation. Like all this stuff, the furniture and appliances improvements, all that could be written off, definitely. Yeah, great questions from everybody. Yeah, really good questions tonight. Well, and that's everything we've got. We went through those 5 things. They're very dense on tax law, and you might have noticed I didn't really list out any tax law or specifics. We could very easily get bogged down in all the details. Like I really like to make, and the podcast is similar to like this, and the way I do my group stuff as well. It's just more general, so you can get the concept of it. And then as you dive into the details and we're applying specific tax laws, I feel like that's the better way to do it, other than just getting overly confused with all sorts of tax laws. But yeah, thank you. I really do appreciate you guys having me on tonight.
Absolutely. Thanks, Brent. This is so informative and educational. Even I learn a lot from your podcast. Your podcast is very, very interesting. Every single podcast will have some new tip. And even your website has a lot of resources too. So I like that. Yeah. Anything to add? This is great.
I mean, thank you really, Brent. I think it was a great session, and I hope everyone who joined the webinar, they found it really useful. And yeah, I mean, all the contents and all the details you covered, those were excellent, Brent. So thank you for taking time. And I know we already top of the hour, long time back, but you stayed with us and you
Yeah,
are.
happy to do it.
Thank you so much for that.
Thank you.
Thank you.
so much, Brent. Yeah, awesome session. I'll have to see the recording again.
Awesome.
And-
Yeah, you guys have a great night.
Okay,
All
good
right.
night,
Yeah, we
everybody.
have a
Thank you.
podcast next week too, so please join us. We'll send the invitation. Thanks, Brent.
Yeah. See ya.
Everyone.